Stop buying things that cost you money every single month. Most people over 60 are sitting on assets that bleed them dry in maintenance and depreciation, and they call it building wealth. There's one rule I follow now that flipped everything, and I'm going to walk you through it. If you want to build real wealth in 2026, you need to hear this. Because the standard advice, buy a house, park money in a fund, maybe pick up a rental property, that advice was built for a different economy. Following it blindly right now could cost you more than doing nothing at all. Think about the things most people call assets: a second car, a vacation home, maybe a boat they use twice a year. They bought these things believing they were building wealth. But every single month, those things send them a bill: insurance, maintenance, storage fees, property taxes, depreciation eating away at the value while they sleep. That's not an asset. That's a subscription to losing money slowly. And it's not just physical stuff. An Axios Global Asset Management Survey found that 79% of institutional investors in the United States expected a market correction. These are professionals managing billions of dollars, and they are bracing for impact. Meanwhile, regular folks are sitting in investments they don't fully understand, hoping the line goes up. That's not a plan, that's a prayer. So here's the one rule that changed everything for me. And then I'm going to walk you through 5 ways to actually apply it, including one most people completely overlook. Stick with me on that last one because it honestly surprised me the most. The rule: only buy assets that produce income, not ones that lose value and cost you to maintain. Every dollar you spend improving an asset should increase what it pays you monthly. Your money should be working while you sleep, not draining your savings while you worry. Sounds simple, but most people have never actually run the math. Tip number 1: run through every potential investment with a monthly cash flow test. Before you put a single dollar into anything, ask yourself one question: does this thing put money in my pocket every month, or does it take money out? If it costs more to hold than it earns, it's not an asset. It's a bill wearing a disguise. The rental property with a leaky roof and a vacancy problem, bill. The dividend stock paying you 3% while inflation runs higher, barely breaking even. The numbers don't lie, even when the brochure does. Tip number 2: prioritize income over appreciation. BlackRock, one of the largest investment firms on the planet, has publicly emphasized the importance of owning cash flow generating assets, pointing to income and patience over short-term market timing. And research from MSCI has shown that real estate debt has offered higher yields than equity real estate in both Europe and the United States in recent cycles. The big players are shifting toward things that pay them monthly. That should tell you something. Tip number 3: stack 3 to 6 income producing assets so that one bad month doesn't wreck your retirement. This is where a lot of people get it wrong. They put everything into one basket: one rental, one stock, one business. And when that one thing hiccups, they panic. Small, steady streams that grow over time beat one big gamble every single time. We want multiple resources. You want multiple sources of residual income flowing in. So if one dips, you barely feel it. Now here's where it gets interesting. Tip number 4: consider a simple product-based business that pays you growing residual income from everyday products people already use. I know when most people hear product-based business, they think it's complicated or it takes too much time. But think about it. You save money on products you're already buying. You share them with others who wants to save money too. and the income builds as more people join, even when you step away for the weekend. I've been doing this for about 5 years now through an affiliate business that creates growing residual passive income. I save money on products I actually use, and I earn as the business grows. It's not flashy, it's not some get rich quick thing, but it's steady and it's real. And it pays me whether I'm working that day or not. That's what an income producing asset looks like. Tip number 5: protect your time by choosing systems that do the heavy lifting for you. At this stage of life, and I'm talking to those of you in or near retirement, your energy is worth more than hustle. You don't want to spend all day on the phone or glued to a computer trying to figure out tech you never signed up to learn. Pick assets and businesses that are designed to run without you. It's babysitting them every single day. The right system handles the selling, the follow up, the questions, so you can focus on living your life. That's the whole point, isn't it? So let me bring this together. You want assets that pay you, not ones that drain you. Run the cash flow test on everything. Stack multiple streams so you're protected. Look at simple businesses that compound over time, and guard your time like it's the most valuable asset, because it is. Just keep moving forward. That's what I tell myself every single day. Now, if anything I've shared today resonated with you, if you're ready to stop letting your money bleed out and start building something that actually pays you, here's a next step worth looking at. There's a turnkey residual income system I've linked below that's built around exactly this kind of thinking. It's designed to work without you, being chained to it every day, which at this stage of life matters just as much as the income itself. Check it out at williamfeaver.com/, and I'll also link it in the description. Thank you and have a great day. Bye bye.